The market has already protected you from inflation with 48% gains over the last 2 years. Take profits now, says this guy, psychoanalyst. And you can see we're getting smoked today here. Look at that, man. So let's take a look. We are, author's rating at publication is bearish. All right, so he's bearish on the market, and the market is now 2.72% right now. Yeah, it looks like it. The 10-year is at 1.39. 10-year treasury at 1.39. Look at that. I still can't get over a 10-year treasury at 1.39. Given this quote, inflation concerns. 30-year treasury at 1.82. That's crazy. So that's a yield, by the way. Just if you wonder what I'm talking about, that's the yield. And the yield is low. That means the price is high. So the yield being so low and being pushed down lower means that the people are buying up these bonds. Who is buying it? I was just talking to a guy just a few minutes ago. He works for an insurance company. He goes, he's not in the investment realm of the insurance company because he thinks a lot of insurance companies are buying up these bonds because they have to. You have to keep a lot of liquidity as safe bets. I completely agree. Insurance companies and pension funds are the biggest buyer of bonds because that's what they have to secure their own debts. So anyway, but if you're only getting 1.82 on a 30-year bond, and that's before inflation and taxes, you're losing money on every purchase. So how does that shake out for an insurance company that has got debts on the? And when I say debts, is liabilities, like a bank. You deposit money in a bank, that's a liability to the bank. It's an asset to you, it's a liability to the bank. So if you got all these liabilities and you're buying up these government bonds to cover them, and you're only getting 1.82, what does that mean for your liabilities when they come due in the future? I don't know, man. It's crazy. Anyway, so let's read what this guy says. Those who fear that going to cash will cause them to lose too much to inflation are ignoring the gains of the past 2 years. I completely agree with that. I all the time. You see my comments. Inflation is going to eat up. I got a guy. He's like, inflation is going to eat up your cash. It's like, well, hold on a second. Got to open the garage. The guy says only greed can justify not taking some profits and saving them for the inevitable when prices once again bear a reasonable relationship to earnings. I disagree with that. I don't think their prices, earnings, yeah, the PE ratios are high relative to normal terms, but we got a 30-year treasury trading at 1.8, man. 1.8. You always have to look at this or that. And if this is at 1.8, then you can make it be higher in value. I don't understand this. I've never understood this. That it's such a high market relative to historical PE ratios. You got to look at it in context with other things you can buy, real estate and bonds. They're both trading high. Dividend stocks are not safer than the market as a whole, as demonstrated by looking at the PE ratios of several popular dividend aristocrats. I completely disagree with that. Good valuation made dividend stocks safe in 2008, but even dividend stocks now are so overvalued that reversion just of 2020's PE will cause serious losses. That's not true. Good valuation did not make dividend stocks safe in 2008. What the hell? Well, let's keep reading. I haven't read this, so what? All right, so we keep hearing cash is trash because inflation will destroy its value. I agree with that. That's freaking stupid. But what people are missing is that over the past 2 years, their stocks have already risen by an amount that far more than compensates for current incoming inflation. Not only that, but the market, which is already quite highly valued for earnings growth in 2020, has risen so high so quickly that a reversion to even the PE ratios of 2020 January would leave investors with painful losses that could take a long time to recover. Yeah, 100%. The loss in buying power you would have experienced from taking profits from the past 2 years' outsized gains and putting into cash is far less than you may experience even if a mild correction occurs. I agree with that, Worms. You're up 50. So you started last January 2020. Well, let's just take a look, shall we? Let's go to Portfolio Visualizer. We're going to start in 2020, and we're going to do VOO. We'll just do a good old-fashioned VOO, and we're going to put that in 100%. Boink, 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 boink. Boink, boink, boink. We're boink, boink, boink. We're going to put 100,000 bucks in there. And we're going to hit this guy right here. And at the end of November, we have $100,000 is worth 145. All right, so we're up 45% at the end of the year. So we take our trusty calculator. We say, what if it drops 25%? 145 minus 25%. we're down to 108. We're still up 8,500 bucks, 8,700 bucks. That's with a 25% decline. Okay, all right. So now we'll see it drops 35%. We got 145 minus 35%. We're still at 94,250. So even with a 35% decline, a significant decline, might add, we're only down 6%. I mean, that's just not so bad. So let's say it drops 50%. We're still, 145 minus 50%. We're down to 72,500. We're still up. We're only down 27,500. And that's just adding it. That's just starting with 100,000 bucks in VOO. Crazy. Anyway, so let's keep going here because he said something about 2008. I was like, I don't think so. Let's keep reading. Once you look at the chart below, it tells you how much the market has grown since 2020. Back then, COVID was still something we read about. I've charted the S&P 500 index since it isn't possible to invest in it direct. Okay, right on. So we already talked about that. So we're up 45%. As you can see, we already talked about it. Of course, anyone who's brave enough to buy VOO around March 20th, 2020 has gained 102%, but you have to buy it with cash. This is another thing people don't get. Cash is trash. If you had some cash on the side for whatever reason and March 2020 came around and you weren't deploying it, A, you're dumb. B, you just made a killer, man. You doubled your money literally in 16 months, 18 months time. Crazy. The earnings per share of the S&P 500 don't begin to justify this extreme price growth. Let's see. You can see what the annual growth of these EPS has been. So I can't see it. As you can see from the graph, the average annual earnings growth rate of stocks that make up the S&P 500 have fluctuated from negative 15% in 2020 to a high of 35% this year. But both that low and that high are outliers, okay? Earnings have grown at a modest annual rate of 7.2. I'll take 7.2% any day of the week, man. 7.2, the 2% dividend, that's a 9.27% rate of return. I'll take it. Nevertheless, price has risen consistently, dramatically, with no correlation to earnings. That to be true. Let's see. We produce a PE ratio of 25.23. He's going to look at it. Yeah, see, he's going to look at it, a 5-year PE ratio. So here we are. It's 24, we're at 27. It's no big deal. Analysts estimate call for an average annual growth rate of no more than 10.5% of the next 2 years. So if we got a 10.5% annual growth rate, man, we're not at market nose bleeders at all. On any stretch of the imagination on stocks. If we got 10.5% EPS, dude, the market today is a bargain. Note that when you look at the broader time scale, one that includes the great financial crisis, the average earnings per growth drops to about 6.27. Yeah, I would say 6%. That makes sense to me. I'm actually saying 4.5. 4.5. I think it's going to be 4. I don't think the earnings per EPS would be going anywhere near 10. I don't think 6 either. But, we'll see. I mean, if I'm wrong, I'm wrong on the upside, which means that if I am wrong, I'm proposing a 6.5% rate of return on stocks, 4% earnings growth, 4.5% earnings growth, 2% dividend yield. And if I'm wrong on the downside, that means I'm pessimistic. That's a good thing, without a question. All right. So you have to. Does the current PE ratio? All right. I don't. Analyst estimates may be too optimistic. I agree with that. I've observed over the years when I look at those analysts' future estimates, they're usually more optimistic the farther away they get. Yeah, 100%. Inflation damages earnings power, and today's high PE ratios don't make stocks the haven they were in 1982. Yeah, okay. Stocks protected against inflation only when PE ratios were low. Well, do they really protect against inflation when PE ratios were low in the 70s? I don't think so. In January 1962, there's always a number, but you can't say stocks are a hedge against inflation, and you can't say they just can't. So I agree with that. But I don't say stocks protected against inflation only when PE ratios were low. I don't believe that for 2 seconds. Not taking profits now is just plain greed. Okay, so I also want to show you something else here. We're going to go back to U.S. Vanguard U.S. Growth Fund. I forgot what Vanguard U.S. Growth Fund. I got to do a U.S. Growth Investor. Yeah, right there. We're going to go back to this. And we're going to go back to 1995. And we're going to hit analyze. All right, so we're putting $100,000 in Vanguard U.S. Growth Fund in 1995. And we're going to hit analyze and see what this sucker looks like. Did I not do it? There we go. All right, let's take a gander, shall we? Look at that. From 1995, the end of 1995, the beginning of 1995 to the end of 1999, it grew to 100, went to 376,000. All right, so we start with 100 in 1995. We're based up to 400,000 by the end of 2000. Everybody with me so far? So we got a compounded annual growth rate of 30%. All right, so now let's go from 1990. We had 300. Hey, buddy. So now we're going to go to the end of 2003. What's up, Finnegan? All right. So remember, we were right there. So we went from 100 to basically 400, and now we're at right there. 166. So we fell all the way to 125 at the end of 2002, and then March of 2003 we're back down to about 127. So basically we fell from 100, went to 400, all the way back down to 127 in the course of 8 years. 8 years. Now I'd say the same thing is going to be happening something like that with Kathy Wood's ARC, by the way. So I mean, the point being is that we're still ahead. I mean, look at that. We're still ahead. Now, let's compare that to Wellington Fund, though. We're going to go BWELX. And we're going to portfolio number 2. All right, blink. Let's go here. And you'll see that Wellington was way below from 1990. I mean, look at this. Here's Wellington red, way below that. Way below. You see what I'm saying? So here's blue. That's the U.S. growth. Here's red. That's Wellington. And basically the U.S. growth was at 425 in August of 2000. Wellington was at right there, August of 2000. Wellington was at 231. So you made $200,000 more in U.S. growth than you made in Wellington. Fast forward to right there, May of 2001. Wellington was at 245. U.S. growth is at 207. Fast forward to right there, Wellington was at 230. U.S. growth was at 127. So you see a lot more of the middling. You see the highs and the lows cut out more. That's what you want in retirement for sure. Point being is that like I was talking about Kathy Wood saying 40% annual rates of return. I don't know how you can say that. I don't know how you get away with that. But on top of that, I say, man, now we're just starting to get greedy, because if we get 40% annual rates of return, I mean, that's what we got here. We got, I mean, look at right here. We had 30% compounded annual growth rate in U.S. growth from 1995 to 1999. But then it ended only at 5.8% compounded annual growth rate, because it got killed in those 3 years after that, destroyed. So even though you might have been getting 40% annual growth rates, you got hammered, dude. Like you wouldn't believe in the next 4 years. Now, you still broke even, but I'd take that Wellington any day of the week over that. Let's go to 2008 too, by the way. I don't know why this guy is saying in 2008 value stocks, they didn't give you reprieve. I mean, just look at this. We're going to go 2008. Here's Wellington, and that's all value stocks. I mean, look at Wellington. Fell freaking from right there. From October 2007 is at 433 to February 2009 is at 298. I mean, it lost $144,000 or so. U.S. growth was from September, base October 2007 right there was at 230. It fell all the way down to 121. I mean, so the whole idea that dividend stocks gave you reprieve, it did it in 2008, because that was when the great financial crisis, financial, that's the dividend paying stocks, insurance companies and banks primarily. Anyway, let's just keep, we're going to go all the way to the end of this time frame. But I've said over and over, if you're not taking gains, you're freaking nuts, man. Lock those puppies in. Okay, gotcha. So look, and now finally U.S. growth has finally made it back up to even. So we're even. Look, so from 1990, if you had $100,000 in Wellington in 1995, it's worth 1.3 million now. U.S. growth is finally just caught up. I don't know how you don't take gains off the growth. I don't know how you don't do that. So if we go to 2009, right there, yeah, let's do that. Watch, U.S. growth has dominated. look for us here. Yeah, look at that. I mean, look at that. U.S. growth, we put 100,000 in 2009, and Wellington is worth 398 now, and U.S. growth is worth $1 million almost. Anyway, yeah. So I agree and I disagree with this guy. How you don't take profits off the table? It's just it's nuts, man. Yeah, I love your thoughts, man. We'll see what you say. Thanks now.